At the beginning of a new financial year, let's take a quick look at FY17 and see what's in store for FY18. For FY17, KLI's frontline equity theme has returned about 23% and opportunities has returned 25% against a nifty return of about 18%. Both these equity themes have also managed first quartile performance during the year. On a 10-year basis, which is a good horizon for insurance funds, these two schemes have returned in the range of 12 to 15%. Balanced funds with 60% equity have returned 17% for FY17 and 10% over 10 years. KLI's Dynamic Bond Fund has also returned about 11% during a volatile rate period for FY17. Moving to FY18, let's look at the macro picture. FY18 GDP growth is expected in the range of 7 to 7.5, making India the fastest growing economy in the world. On the back of benign inflation during H2 FY17 at 3.6%, we expect CPI to average 4.5 to 5 during FY18. On the external front, FX reserves at over 370 billion is a healthy 12-month import cover. CAD is expected to be manageable at 1.2 and Indian rupee is expected to be in the stable range of 65 to 68. On the global front, we should watch out for implications of three themes. 1. The US moving from monetary to fiscal measures. 2. Trade protectionism. And 3. Global liquidity. Domestically, the shift of financial savings is expected to continue.
Earnings growth for corporate India has been subdued for last 3 years due to falling commodity prices and consequent increase in credit costs for the banking sector. Significant initiatives taken by the government on economic reforms like fiscal consolidation and opening up of FDI and on ease of doing business should start yielding results in FY18. The economy should grow at a faster pace going forward due to favorable macroeconomic backdrop and recovery in a global economy which should help exports. We believe that corporate India is on the cusp of recovery in earnings growth cycle as credit cost has likely peaked out and economic growth recovers. Nifty is trading at trailing price to book of 3.5, which is in line with long-term average. FI have invested $25 billion and the domestic financial institution has invested $13.2 billion in last 3 years. We believe this trend to sustain due to the relative attractiveness of India in the regional context and government's emphasis on promoting financial savings. What are the risks to our outlook? 1. Monsoon. There are some early indications of weak monsoon which may impact growth. 2. External shocks like faster than expected tightening by US Fed or increased trade protectionism can impact investor sentiment. We should remember that equity markets are slave of earnings in the longer term. Hence, we believe equity markets offer an attractive opportunity with 3 to 5 year view due to improving earnings outlook and reasonable valuation.
FY17 was a good year for debt funds, aided by drop in inflation and easy rate policy. The current year will be a year of accrual as the rate easing cycle is nearing the end, since RBI has turned cautious on El Nino prospects and impending rate hike cycle in United States. Market will be watchful of monsoon performance, rupee movement and global liquidity to take cues on likely RBI moves. Bond yields will remain in the range of 660 to 7 as RBI has adopted neutral policy stance. We believe the current episode is different than previous episodes of changing rate stance by RBI. Investors in debt funds should take comfort from high real rates in the current cycle. High real rates will ensure the reversal of monetary stance to be less steep. In fact, high yields should attract foreign flows, capping sharper hardening in bond yields. Risks to our view are higher food price inflation affected by poor monsoon, current farm loan waiver episode spilling over to more states which will impact fiscal position, faster rate hikes by United States and higher global commodity prices. So over the medium term, cautious monetary policy stance can ensure lower inflation of 4 to 5%, making the case for increasing duration if bond yields harden. We believe prudent fiscal management and inflation fighting rate stance to augur well for inflation and interest rates in longer run, aiding performance of all financial instruments.
To conclude, bonds are expected to provide accrual-based returns with some volatility. If we look at the Sensex earning yield to GSEC yield ratio, it indicates a bias for allocation to equity with a medium to long-term horizon, especially for insurance investors who are long-term in nature as also have a design for rupee cost averaging through payment modes available. Allocation to equity should hold in good stead. Best of luck to all and happy investing.